All right, so today I've been asked to talk about the buy the dip phenomenon, BTD or BTFD, if you want to be a little unsavory about it, and have a little bit of more emotion and enthusiasm behind buying the dip. So this is pretty simple. I don't think it should take too long. This is a 3 year long chart of IVV, which is the iShares S&P 500 ETF. So this ETF, the objective of the ETF is to track the performance of the S&P 500 index, and it trades basically its denomination is the S&P 500 index divided by 10 roughly. That's not exactly how it's not priced that way, but just when you see the number 475.5, if you multiply that by 10, that's probably really close to where the S&P 500 was at that time. So 4,755 to be clear. Okay, so by the dip, yeah. So you see these little red candlesticks. These indicate down weeks. The time period. Each one of these individual candles is 1 week of price performance. And so in general, if you believe stocks are going to go up over time, then buying the dip is basically by definition the right thing to do, because you're going to get cheaper prices. So looking at this here, you can see, let's see. Yeah, sorry, I was thrown off. I was seeing this 2020 year dividing line thinking that to the right was 2020, and that doesn't make sense because this is coronavirus and quarantine. So it just means to the left of this line is 2020. So the middle section here between these two dotted blue lines is 2020. So you see coronavirus. And one way that you can think about the dip is that let's say that it's just implied that you believe that over the long term stocks go up in value, and there are a lot of fundamental reasons for that, not the least of which is we live in an inflationary society on purpose, which I mentioned in another recent video, and stocks are claims on real assets, and therefore stocks typically keep up with inflation over time, and their dividends and their earnings as well. But anyway, okay, so let's say that early 2020. This is February 2020. February 2020. You can see the little time frame at the bottom of the screen moving left and right. Let's say you bought this dip. Well, that wasn't very fun for you because then you got a little bit of a reprieve here, but then the market continued to decline pretty dramatically for a long period of time, and the world was ending, and every company on earth was going to go to zero value, and nothing had any meaning anymore, and the world was ending, and everybody was selling. You can see it with the volume spiking here, down here, these blue bars. And if you can sense the sarcasm in my voice, that's on purpose. The world is not ending, and things are not all catastrophically going to zero overnight or over the course of a month. But anyway, if you bought this dip, you got a little bit of a reprieve, and then you suffered for it. But the other way you can think about this is if you believe that everything is not going to go to zero and stay there and permanently nothing has value anymore, then presumably at some point the market is going to return and maybe even surpass the previous high as we know that it did. And so the way you can think about this is, well, okay, so let's say right here the market dropped down to, if you look at the far right of the screen, 294.3. So $294.30 for this ETF. When was the last time it was there? And so if we scroll back over to about right here, the last time it was in that region was October 7th of the week of October 7th, 2019. And so one of the ways to think about this is when the market has one of these dramatic downturns like this, essentially it's offering you the opportunity to put more money in and sort of get time back, if that makes any sense. Again, it's going under the assumption that you believe the market will eventually turn around, and you don't know whether it's going to continue to decline or whether it's going to start going back up. You don't know which way it's going to go, but it does offer the opportunity to say, geez, let's back in October of 2019, the market was at 293, or this ETF was share price was at 293. At the peak, it got up to around 340. Wouldn't it have been nice to dump a bunch of money back in when it was 293? Well, this gives you that opportunity. It has placed you back in time, in this case, 4 months or so. So that's one way you can think about it psychologically. When the market's going down and you are buying the dip, is it's giving you a chance to go put more money in back in time, where again it's all under the assumption that the market will recover and go up. So that's one way I think about it. But yeah, buying the dip. You can buy the dip, you can get burned, and it can continue to decline. Or if you have a long enough time horizon and just belief in global economics and markets that things will recover, you don't know whether you're going to pick the bottom, and in fact you have an extremely low probability of picking the bottom, and most likely are not ever going to pick the bottom, nor are you likely ever to pick the top to sell. But you can start putting more money to work. Maybe if you had if you had $100,000 of cash sitting around somehow, maybe you leg in a little bit, and you don't know how to divide it. Maybe you don't put all 100,000 in after that terrible week. Maybe you put a third of it, or a quarter of it, or half of it, or whatever, and save it. But the key is, when you do that, you have to do it based on dates, in my opinion, to manage your own behavior. You have to do it psychologically. When the market has done something as terrible as it did during this time frame, there are going to be a billion reasons not to put your money in, because this time it's different, is the way that you and any other human being, including me, will feel about it. And so you have to promise yourself that you're gonna just do it based on the date, regardless of what's going on, because you're definitely not going to have a lot of confidence that it's the right time to buy. There's always another shoe to drop. There's always another scary story on the news, whatever. So you don't necessarily have to put all your money in every time you see a dip, all your spare change that's available every time you see a dip in the market. You can always keep a little bit of dry powder, so to speak, that's available to be used, and put in a little bit more. So anyway, and the other thing I'd say about this is, this all assumes that you have excess cash available to dump into the market. And if you don't, the buying the dip thing really, it comes down to just your ability to rebalance into these out of favor securities. Because if you don't have new cash coming in the door, whether it be from salary or other, whatever types of income, supply you with new investment dollars. If you're retired, for example, you may not have cash on hand to buy the dip. And so this is when doing things like rebalancing are your methods of buying the dip. If you had a 50% stock portfolio and suddenly it declined dramatically, and now your portfolio is 40% stocks and 60% bonds, just because the market value of your stocks dropped so precipitously, the only way you buy the dip is by selling those well-performing bonds and buying the crummy performing stocks. And that also takes a lot of intestinal fortitude. And it's not easy to do. So that's one reason that it makes sense to automate things like rebalancing on a calendar basis. Doesn't mean you can only do it on a calendar basis, but doing it at regular intervals, or at least checking to see whether you need to rebalance at regular intervals, can help remove some of those behavioral biases that will prevent you from rebalancing into out of favor assets. And if your calendar date happened to line up with this period of time right here, lucky you, but that's extraordinarily unusual and rare, and most likely is not going to be the case. But the point is, nobody knows when these bottoms and when these tops occur. There is a thing called technical analysis, which I've heard as referred to astrology for men, which I think is a hilarious way to describe it. Some people really believe in technical analysis, but just like you can find patterns in clouds, doesn't necessarily mean they're there. So that's sort of my 2 cents on that. But anyway, if you're in an accumulation phase and you have extra cash coming in the door, Buying the dip with new dollars can certainly be a good strategy if you assume that stock prices are going to continue to rise over long periods of time. If you're in retirement or you don't have excess dry powder, then the way you buy the dip is by rebalancing into the out of favor securities and out of the in favor securities. And both of those things are really, really hard to do from a psychological standpoint. And so it's important that, to the extent you're willing and able, you need to get yourself on some sort of periodic based investment strategy rather than relying on intuition or anything like that to do it. Okay, that's it. I think I've covered that pretty extensively. Thanks.